with all this volatility in the markets, we are currently experiencing an unbelievable trading market. And so what I would like to share with you here quickly is position sizing. It's a very simple exercise, but an incredibly important one to do. So what you have here is two lines at the top of the S&P 500, at the bottom we are looking at something called average true range, or ATR. And what it essentially is how much is the average daily move of whatever the asset we're looking at. In this case, we're looking at the SPY tracker ETF of the S&P 500 in the top chart. And you can see, as a result of the recent volatility, this ATR, or average daily range of the S&P 500, has spiked from like 9 to about 20, which is unbelievable. And so what that means from a position perspective, whether one is swing trading or maybe even day trading, or really any kind of position sizing outside of maybe long-term investing, it just means we have to take our position sizing down. Because if you think about this, if the S&P 500 on any given day is moving now twice as much as usual, there's more risk at hand at any given day. So if I, let's say, buy 2 options contracts on any given day when the ATR is half of what it is right now, then I literally should only be buying 1, let's say, call option contract, or X amount of shares, or X amount of futures, right? So this is a really important exercise. Now, also, the other point, this is kind of a bonus point about this, when the average true range for, let's say, the S&P 500 reaches where it is right now, you can see it's actually even way above where it was in COVID. It typically kind of tends to peak. So that also kind of tells us that the volatility might start to subside here going forward. Hope it helps. And see you in the next video.